Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and one of our portfolio managers. Thank you, as always, for joining us and giving us some of your time where we can talk about the things that we find important going on in markets. Today, we've got a couple of topics to cover you. One is going to be kind of broken down in detail. Those will be the bottom three there from Andrew on seasonality. Something that just remarkably in this business stays with us. I've never understood it. But there seem to be some teeth to that topic, and we always keep it there, and he'll unpack it in three different ways. And I'm going to cover bonds, one of my favorite topics here, but and we'll dive right into that, actually. So there was a common terminology in the 2000s for the S&P 500. It was called the lost decade for stocks, and that's because essentially the S&P 500 went nowhere. There was a big bear market in the beginning and the end of that decade, and you add those together, and any of the gains were wiped out by those two. And we've seen the same thing happen in bonds here. So we've got two lines on this chart. We've got the orange, which is the U.S., and the white is global. So just to keep things simple, it's going to be the same general theme here, but let's just look at the U.S. That's what matters most to us when we're purchasing bonds. We want to keep them onshore for the most part. In U.S. dollars, because that's what you all spend, again, for the most part. But we take a look now where that current level is of total return on that orange line, and you trace that back. There were gains going up in through 2020 and into 2021, but then last year, of course, the big bad bear market in bonds set in, and it's been extended into this year. And if you trace that all the way back, you're going all the way back to 2008, 2009, in that great financial crisis era. So essentially all of those gains. Now, this is in real terms, which is what matters to us. Of course, if you were to look at it in nominal terms, what's printed on the statement, there is some modest gain. But when you factor in inflation, which is what we're looking at here, that has been all but wiped away. Now, there's some good news. Right? This is a look backwards. It's to show you what has happened. And what we can say during the past decade is there has been consistently what we would call negative real yields in bonds when you purchase them. And the beginning yield on bonds is a pretty simple but straightforward and fairly accurate indicator of what your total return is going to be going forward. So when the current yields are -1, -2, once you factor in inflation, or maybe even -3, you're not likely to have blockbuster gains. You did for a while, but eventually that comes home to roost. And you didn't. So if we go to right now, we have a very different picture. And we finally have some real yield, even after you back away inflation. So if you have a 2 or 3% inflation, wherever we wind up being, that is less than the 5 or 6 or maybe even 7%, kind of depends on what kind of risk you're taking, bonds that are out there. So going forward, we've got to feel a lot better about the opportunity to actually build some wealth inside the fixed income. So that's the bond side, and I will pass the baton over to Andrew to talk about seasonality in stocks.
All right, thank you, Adam. So we've talked, I think, a little bit about seasonality several weeks ago. We talked about how August and September have been some struggled periods historically for the market. For when we look at seasonality, when we look at kind of the trends for each month, and the market doesn't always follow these trends, but we want to be cognizant to them. And so when we came into August, historically, the market has seen some downshifts. Specifically, we looked at, if you remember, if you watched that video several weeks ago, we looked at the pre-election year seasonality and looking at all the previous pre-election years, and they all began to kind of start to turn lower in August and saw some volatility pick up between August and September. And so we're seeing that as we now shift into September, typically the seasonality stays fairly dire. Historically, though, we do see a pickup at the end of August. We've seen that last week. Market bounced about 1%. We're seeing the start of this week, a little bit of a bounce here. So I have three different charts of seasonality that we're going to dice up a little bit here. The first one looks at all the Septembers going back to the early 1990s. And this shows the performance just in the S&P 500 and just in September. You can see the last three Septembers haven't been great. They haven't been the best friend for the S&P 500, notably last year when we had that bear market. September actually was down nearly 10% on its own. And then the previous 2 years also saw the market soften in September. Notably in 2020 and 2021, those were both strong years following the COVID crash, but those were strong periods for the market. So even during when the market was rallying, it did begin to struggle a little bit just in September. And then if we often see year-end rallies. And so we can see historically going back that we've had several periods, several heightened volatility periods in the month of September. Now we're going to zoom in a little bit and look at the next chart. Get that up on the screen for you. This is looking at annual seasonality. We can see here that typically the S&P 500 does well most months. This is looking at the average monthly performance going back to 1970 for the S&P 500 on each month. And you'll notice one standout. There's one red bar on this chart, and that's September. Historically, September is a weaker month. It's actually the weakest month since 1970 across the board for large cap stocks. And so we have to be cognizant of that. And we're actually can take things even zoom in even further and start looking at, is there anything within the month of September that really kind of helps us see where does that weakness typically come? And that's what the third chart I'm going to share with you. And now we're zooming in and looking at the daily seasonality within September. And what we can learn here is that historically, the weakness in September comes more towards the end of the month. We typically see at the end of August, stocks begin to rally. That continues a little bit at the start of the month. And we really see the back part of September. You can see all those red bars on the far right side of your screen. That's when we start seeing historically some of the rougher choppiness in the market. And so what does this mean for portfolios? Is this something we need to act on? This is where we consider this to be secondary type data. This isn't something we're going to immediately trade on. This isn't an input to our models, but we want to be cognizant to it. We want to know when there's potential for volatility to come into the market, to be aware of that. And on the flip side, we want to be aware when the market ignores seasonality. That can be just as important. If we have this historically struggled period for the S&P 500 and the market bucks that trend and goes higher, that's showing a lot of really good strength. For it to rise and be really strong in a historically weak month could be a very, very positive sign when the market goes against those seasonal trends. And so that's something to be aware of too for September. And so we do take this into consideration with our analysis. We're doing that all day long to look for opportunities for the portfolio. And we want to look at where is the kind of the tailwinds from history suggesting for the next month. And historically, September has been a little bit rockier than some of the other months.
Yeah, well said there, Andrew. And I just add a little bit to that there when you say secondarily, just to put a little bit extra on how we can think about that is when we're kind of on the fence. And to be honest, we're going to be on the fence from time to time. You've got a signal here that tells you should buy something or you should sell. And we're just not quite sure. We'll use that seasonality to help us fine tune the timing. So if we have a little bit of cash build up in the portfolio, we might just be a little bit more patient than we otherwise would be. So it is very, very helpful to have over time. So once again, thank you, Andrew, and thank you to all you for giving us a few minutes of your time. Hope everybody has a great Labor Day weekend. As always, we'll send you off with a reminder to give us a call, 800-928-4001, or book an appointment online. So thank you. Have a great and fun Labor Day.